Thanks very much, Lars. And this is joint work with Julian Kozlowski, who's at the St. Louis Fed, and Venky Venkateswaran at NYU. Like all COVID papers, this is a new one. So we haven't given this before. Please give us lots of feedback. I'm interested in all the questions, even if we can't get to them. And Venky and Julian will be fielding a bunch of them as we go and taking some more at the end. Okay, so a little bit of context. Economic upheaval, we're in the midst of one, and it's typically had long-lived consequences. So we've heard a bunch about the consequences of the Depression, like Depression babies from Nagel and Malendier. We've heard about World War II and how that created long-lived technological changes, changes in labor force participation. There was a literature on financial crisis and the secular stagnation that followed. All of these big events have long-lasting changes. So it raises the question, what will the long-term consequences of the COVID pandemic be? And to answer these kinds of questions, we really need theory. We don't have data about what will happen in 5 or 10 years from now, and extrapolating from past data is not a particularly good way to get to what the future will look like if we think that we're in the midst of a structural change. So we got to write down a model. So let's think about what ingredients that model should have. So once a vaccine comes, why wouldn't we return back to normal? What are the possible reasons? Well, one of those reasons, we'll have a few built into our model, but one key one is the world will be different even after we're all vaccinated because we learned something. What did we learn? We learned that epidemics don't just stay contained in Asia. They actually can affect us here in the United States. They can get to Europe, they can become global, and they can have big economic consequences when we lock down the economy in response to them. And I didn't know that before. I didn't think that that was something that would happen here. So then the question is, okay, we're going to have learned something that this is more likely than we thought. How can we measure that, and how can we quantify the effect of that knowledge that we've gained? So what we're going to do is we're going to treat agents like econometricians. We're going to have them form beliefs the way that we would estimate something. We're going to look at the past data and say, what do you estimate the distribution will be? Now you've seen a new event. How do you re-estimate that distribution? Okay, so beliefs are distributions over outcomes, and our agents will re-estimate them as time goes on. So we're going to put that into a model. We're going to have distributions based on past data. We're going to have distributions that include no new realizations with COVID in there. And then we're going to feed those updated distributions into a macrofinance model. And our main finding is that the long-term costs of this pandemic are many times larger than what people estimate the cost during the pandemic to be. So I don't know if any of you have been watching the series SGN, Some Good News. It's been broadcasting on YouTube with John Krasinski. It's kind of fun. I feel like I've just invented SBN, Some Bad News. And the bad news is this is likely to be way worse than we thought. Okay, so what's our main mechanism? No one knows the true distribution of aggregate shocks. I mean, that's just a fact. You don't know it. I don't know it. And sometimes not knowing it's not that relevant. So when we're in normal times, we're seeing a regular boom, a normal recession. We've had a lot of those. We've got lots of data on them. We don't know exactly what the probability weights are, but we can estimate that pretty well because we have a lot of experience with them. But when we see tail events by their nature are rare. Rare means we have scarce data on them. So if we haven't seen many of these things, the fact that we don't really know what their probability is matters a lot. Okay, so beliefs about tail events are particularly important because tail events are events for which we have scarce data. And so we're going to see one of these, and our agents are going to re-estimate their beliefs. They're going to re-estimate this distribution of outcomes as new data arrives. Okay, so how do we do the estimation of beliefs? We're going to use a non-parametric approach to estimation. It's not essential to what's going on here. One could use a parametric. One could do this in a Bayesian way, but it's going to be fairly simple. It's flexible. It avoids distributional assumptions, and it allows us to get at, really what's the probability in the tail versus what's the effect of, say, uncertainty, a more generalized measure of distributions that others have talked about. So we're going to use observed macro data. So our beliefs will be absolutely disciplined by macro data. We're not making up belief shocks here to see how big an effect we can get in the economy. We're getting our beliefs from the macro data. And so we're going to put in a tail event. That's going to be the COVID-19 shock. That will be a 2020 realization. And we're going to see some large, I don't know, large, but larger than we would have seen if we'd put in a normal event. Okay, so whenever we get a new piece of data, we always update our distribution. We always change our beliefs. But for data that's not so extreme, we just don't change it very much because we've got a lot of data in that part of the distribution. And so these tail events give us bigger changes because data on these things were scarce. And these changes in beliefs are long-lived. Even if the underlying shock is IID, or even if everybody gets vaccinated for COVID and it works perfectly by the end of the year, we're done with this, there's going to be a long-lived effect because we know that this could happen again. So we're going to take a standard SEIR, susceptible, exposed, infected, recovered epidemiology model. We're going to embed it in a macroeconomic framework or a macro finance model, and we're going to see what happens from it. Why this framework? Well, because we just used it in our forthcoming JPE article and showed that it was quantitatively successful in explaining the post-financial crisis period. So we're going to see what this framework has to say about COVID, and we're going to add a bunch of new features to it, like this epidemiology, so that we could ask questions like, what happens if we have stronger or weaker lockdown policy? How does that matter for the future trajectory of the disease, of the lockdowns, of the macroeconomy, and also of asset prices? Okay. So we're going to start with explaining belief formation because that's the novel element of our approach. And then I'll show you the rest of the economic environment. So we'll have an epidemiology model and a standard economic environment. Then we'll talk a little bit, I don't have a lot of time today, so calibration is going to be pretty brief. We're going to talk about the disease, the COVID scenarios, and then get as quick as we can onto the macro and finance results. And at the end, I'm going to show you what does this mean for asset prices going forward, not just today or tomorrow, but where after the dust settles, what kinds of levels do we think these asset prices might level out in the long run? Okay, so belief formation. So consider an IID shock. For right now, this could be anything. It's just some stochastic process, and we're going to ask how will agents in our model form beliefs about the distribution of this shock in the stochastic process? Okay, so shock is phi t. We see one of these every period t, and they've got some unknown distribution g. And your information set is a finite history of these shock realizations. So it can't be infinite. If we're infinite, you could figure out exactly what the distribution was. You wouldn't have to change it ever because you'd know for sure what it is. So it's got to be a finite. It could be long finite, but it's got to be finite. And we want a flexible specification that can capture tail risk. So a simple way of doing this is using a non-parametric estimator. The most common one, you open your econometrics textbook and the first thing you find about how do I estimate a distribution will probably be the Gaussian kernel density. Now, don't let the Gaussian name fool you. This is not going to estimate a normal distribution. It's going to use a whole bunch of little normal distributions added together, which adding normals together, it does not give you a normal. Exponential plus exponential is not exponential. So we're going to get basically what's going to be a histogram of all the data we've ever seen with a smoothed line over top of it. Okay, so the way this thing works is this is a normal PDF. Gosh, my handwriting's bad to begin with, and it's particularly bad on screen. That's supposed to be normal PDF. And every time you see a realization X, you're going to see one of those. What you're going to do is you're going to put a little dot there. That's your data point, and you're going to drop a little bit of normal density around it. And then you're going to see another X, maybe over here, and you're going to drop a little normal density around that. And you can already see that the sum of this and this, you add those two densities together, is not normal, right? This is something that's got two peaked. And so you take all the data you've seen, maybe it kind of, it gets a histogram like that, and you end up having this smooth line over it. But the sum of normals is not normal, and therefore we can get very flexible forms. Think of this as histogram with smooth line. And then, of course, when we add these, we've got to normalize it by the number of data points and t we're putting in there so that this density integrates up to 1. Okay, that's all we're doing. Now, the key feature of this is that beliefs are martingales. What does that mean? It means that tomorrow I should expect to have the same distribution on average that I do today. So I shouldn't believe that tomorrow I'm going to put a lot more probability weight on bad events, because if I thought that tomorrow I was going to believe bad events are more likely, I ought to believe that today, right? Why would I think that tomorrow I'm going to think something different if I don't think it today? So mathematically, that's called the Martingale property of beliefs. And what it means is beliefs move kind of like a random walk. If you add a little bit to a random walk, it's with you not just tomorrow, but for the infinite future afterwards. And so just like that, when you see a data point and you put it in your data set, it's going to affect your beliefs for many years going forward. Okay. So let me operationalize this and put in a particular stochastic process and show you how we estimate beliefs and how those beliefs evolve over time. So this is a capital return series. It's not that important what it is, but you see the time series in panel A here, okay? And the key thing is that there are two outliers. There's one about here and one about here that happened during the financial crisis, okay? So this is just an example with this older data. So prior to seeing these two extreme events, if we cut this data series here, you get this kernel density estimator in blue. Okay, so it's got some bumps at the top, it's not much going on in the tails, but then you add these two data points and they're exactly here and here, and you get a little bit more probability density mass in that distribution. So this change is subtle, right? It's not that this looks wildly different. Now let's do the exercise where we draw future time series like these for another 30 years. We're going to draw time series that do not have future crises in them, so there's no observations like these two. And for each of these sequences, we're going to ask 30 years later, what does the kernel density estimator look like? Okay, and we're going to do thousands of these draws. And that's what this gray is. That's the 2 standard deviation band for future belief distributions. And the key thing is it still has a left tail. So the fact that you saw the financial crisis means that 30 years later, you put a higher weight on there being bad events in the future, okay? So that's how we're gonna get persistence out of beliefs. You see a piece of data and you just don't forget it. The event passes, but the knowledge is with you forever after. And that's our belief scarring. So we're gonna try to quantify how that might happen in the COVID crisis and what kind of long-term consequences it might have. Okay, so here's the COVID model. Let's start with an epidemiology model. This is an SEIR model, susceptible, exposed, infected, and recovered or dead. From the point of view of economics, unfortunately, these aren't so different. Susceptible. So how many people are susceptible today? Depends on how many were susceptible yesterday. And we're going to lose some susceptible people. So susceptible means you've never had the disease. So that's a shrinking set, right? Anybody who gets it ever is no longer susceptible in this model. So who gets it? Well, there's a contact rate beta. That's how many people you bump into in a day. And then you ask yourself, what's the probability that somebody I bump into will make me exposed to the disease? Well, that's the fraction of the population N that's infected, okay? So this is like a random matching model. People are bouncing around the economy, and there's a probability I over N that I bump into somebody, that the person I bump into is infected. I bumped into beta people in a day, so that's the loss rate of susceptible people. The exposed people are people who were exposed yesterday. These are the people who were susceptible, that's this term here, and are now exposed. And there's an exit rate of exposed. So this is the rate at which exposed people become infected. Okay? Infected are the infected yesterday. They're the people who were exposed and now infected. And then there's an exit rate of infected people into recovered or dead. We're gonna call it D, it's a little morbid, but we're using R for lots of other things in the model. So tomorrow's dead, or today's dead, plus the people who were infected and are now dead or hopefully recovered. Okay, so what's the role of policy here? Well, policy affects the beta, the contact rate. If you think effectively, what did a lockdown do? It made sure that I meet fewer people in a day, right? That's its goal. So what that contact rate is, this gamma just scales this contact rate into these R's. We've probably been hearing about these reproductive rates R naught, and what does Fauci say the R naught is? Well, that's this R naught. It's the number of new cases that an infected person will spawn, okay? So that's their contact rate times how many periods they stay infected and contact other people. That's the gamma I. Okay, so we're gonna say at a maximum you can have R naught. R naught is at the beginning of the disease when everybody's susceptible and there's no lockdown. How many people do you infect? So that's a max. A min, well, we're gonna look at the US regions that had the strongest lockdown and what the estimates of R, the reproductive rate, are for those regions, and we're gonna say, The US, either due lack of political will or whatever, isn't going to get lower than that. And then in between the max, R0, and the min, R min, there's a range of possible reproductive rates that you could get, and they depend on this policy parameter zeta. Okay, that's something we're going to vary, and it depends on lagged infection. So we're going to take the stand that infection rates take about 15 days to detect or show up. So this policy, by the way, is something we're just writing down. Okay, this is an assumption, but it's rooted in how politicians are describing their reaction to COVID. And so when I hear, Governor Cuomo, or I hear the CDC say something like, we're going to open up if we see the hospitalization rates fall for 15 days, that's kind of what this is. Okay, so people are getting hospitalized about 2 weeks after they get infected. So we're starting with about a 2-week lag. And this is averaging over those 15 days versus the 15 days that came before them. So that kind of represents a 2-week decline in the average hospitalization rates over a 2-week period. Okay, so we're going to say that policy, how much we lock down, how much we force people not to meet each other, is going to depend on these average lagged infections. Okay, so shutdowns are important. How do they matter economically? Because they idle capital. Okay, so if we reduce beta, which is our policy lever to get people not to bump into each other and get the disease, it's also going to make some capital go offline. How much? Well, it's this, I think that's a new, and it depends on how much we reduced beta gamma relative to R naught. So no lockdown would mean zero difference between these two. And at most that difference is R naught minus R min. Okay, so how aggressive policy we have determines how much capital gets shut down, and that sensitivity parameter nu is governing that. Now, a key thing is that idle capital is going to depreciate, or it's going to become obsolete, really. And this represents the idea that when we shut down, there are all kinds of reasons why the capital not being used may not be used as intensively again in the future. So it could be that, after this, at the margin, I might not go out to eat quite as much because I recognize that there are health risks of doing that. It recognizes the fact that I'm really not likely to go back to theater again for quite a long time, that I probably will do more conferences on Zoom and use airplanes less and hotels less. And it reflects the fact that JP Morgan, the largest landowner in New York City, just announced that they're going to have some permanent work at home policy for many of their workers, maybe rotating through the office, and try to reduce their demand for office space substantially. And so a lot of the capital that we had in the pre-COVID economy is not going to be well adapted to the preferences and risks of the post-COVID economy. And so we're going to think of this maladapted capital. This is like a period of accelerated technological change. We always knew that technological change made some capital obsolete, and we're speeding that up. So anyway, out of all of this disease stuff, it's there to help us understand how this environment maps into temporary shutdowns, which result in the permanent and transitory or permanent obsolescence of capital and transitory loss in productivity. Okay, those are going to be two sufficient statistics for everything that goes on in this SEIR model, which we're going to let rip through 2020. Okay, so here's how we map this into the economy. So we're taking our economic model from mostly from Francois Goriot's work in the AER and AEJ. That model is well suited to think about tail events, and it also does a good job of making the shocks that hit the macroeconomy do something plausible in terms of asset prices. Okay, most real business cycle models fail miserably on that dimension. Francois doesn't. So those were two key features that were important to us and made us adopt this framework. So I can tell you a little bit about how some of those, what pieces of the model did that. So we have a representative household with Epstein's in preferences. They like consumption, they dislike labor. The production looks mostly pretty standard. It's like a Cobb-Douglas production. We've got TFP here. We've got some capital here. I'll tell you about what that fee thing is in a second. And we've got labor, okay? And so this fee is this obsolescence shock. So we had a bunch of hotel capacity, and we're not using it now. And we're not going to use it much in the future either. So a bunch of that's kind of depreciated. And then we've got a temporary productivity shock that is also linked to fee, okay? We don't think this is true all of the time, that obsolescence shocks and productivity shocks are linked due to the same shock, but for the purposes of COVID, they're both arising because of the lockdowns. It's the lockdowns that cause the temporary loss of productivity, and it's the lockdowns that are causing us to change our habits and adopt new technologies that are making some of our capital obsolete. So we're going to link them both to the lockdown shock fee. So there's a law of motion. Tomorrow's capital is today's capital, the depreciation rate and investment. And then we've got firm credit and labor market. So far this is pretty standard, except for there's both this capital shock and a productivity shock. Okay, and the capital shock is really there because if you're going to get any movement in asset prices, TFP shocks don't really get you there very much. Okay, if whacking the capital really does a good job of making equity prices move. Now, we've got firm credit and labor markets, and this is part of what makes this model sensitive to tail risk. So we're going to have firms that borrow in debt and issue equity, and that's nice because it's realistic, but more importantly, it's useful here because debt is this asset where the payoffs are constant throughout most of the state space, except for when really bad things happen. When really bad things happen, the value of debt is really sensitive to exactly how bad that is. Well, that's creating extra sensitivity to very bad events. Okay, so it's going to get us extra sensitivity to the risk of a tail event. So the way that market works is firms borrow with one period defaultable debt, as in Eaton and Gersowitz. They've got idiosyncratic shocks that lead to positive default in equilibrium. So basically, we just don't want all firms or no firms to default. This creates some heterogeneity. And then there's this default feedback that's going to trigger more capital depreciation. So this is this obsolescence here. So the role of this thing is it's going to soup up our shocks a little bit, honestly, about 50%. But also obsolescence is going to give us a way to think about financial policy in the context of this model. So if you think about what might finance, what might the Fed, what might bailouts do to this economy? Well, it's not going to make the disease go away. It's not going to make the fact that we separated capital and workers any less costly. But what it does do is make that knot ripple through the financial sector and amplify by triggering more loss of value and more default. Okay, so you want this piece in there if you want to think about financial policy, because that's really where financial policy can be operative. Okay, so the way this is going to work is this phi t that hits capital, the thing that enters up here, is this piece, which is the direct effect of the disease and shutdown. And this is the thing we're learning about the distribution of. So that's what happens from the epidemiology model. And the default rate, okay? And the default rate is an optimal default in this Eaton and Gersowitz style. So the more people default, the more capital depreciates. Okay, so we've got this distribution of aggregate shocks, G, that's unknown to agents. At each date, they're going to observe this phi tilde. So this phi tilde is how much capital was lost due to depreciation during this epidemiology episode. Okay, so we're integrating over this 1 year time period. And the lockdown, there could be one lockdown, in some scenarios there are multiple lockdowns, but how much lockdown was there and how much depreciation was there day by day, depending on how locked down we were. And that's what's generating our phi 2020. And we estimate this with a Gaussian kernel density estimator, like what I explained to you before. So you might ask yourself, how does this G thing that they're estimating, this distribution of capital returns that are linked to COVID, how does this thing work its way into the model? And the primary means by which this shock makes its way into the model is through a firm's cost of capital. Okay, so let's look quickly at what that cost of capital is. Okay, so we're talking about a bond, and its main risk of loss is coming from here. This is the bankruptcy cost. Okay, so this thing is a probability density that your firm value crosses is lower than a lower bound. And in those states of the world, you want to default. So 1 minus that are states where you don't default. These are states where you do default, and your recovery rate upon bankruptcy is theta. This thing is your stochastic discount factor. Okay, all of that looks really standard. Where does G enter? This is an expectation, and it's an expectation given your beliefs G hat. So what happens when you have this negative data point that shows up and changes your beliefs is that it's going to cause you to put more probability weight on bad outcomes, and it's going to change the way you take expectations over this value. And so it's going to end up changing, in this case, raising a firm's cost of capital. Okay, so measurement and calibration. How am I doing? I've got about halfway through. Yeah, good. So how are we going to measure this stuff? So we have to estimate the history of this depreciation shock to know what their beliefs were before COVID. So the way we're going to think about this depreciation, and this bit is following what we did in the JPE paper. So I'm going to go through it pretty quickly and refer you to the previous paper for the details on how we did it. But we're looking at effective capital divided by what was yesterday's effective capital or value of capital plus the investment. Okay? So if there were no changes in capital valuation, we would think yesterday's capital and investment, we're going to depreciate yesterday's capital a little, add some investment, that should be equal to today's effective capital. That's effectively a fee of 1. But if the value of the capital stock just got whacked today, and it wasn't because we didn't do any investment, then we're going to call that a depreciation shock. Okay, so we're looking at non-financial assets of U.S. corporate businesses. This comes from flow of funds. A lot of this is commercial real estate, about 55%. The other major categories are equipment and software. And we're going to use the market value of this stuff to tell us about the effective capital and then historical cost to get us investment. Okay, so we're doing a price adjustment for the price of the investment price index here. And then this is just this ratio up above. Okay, so this is going to be, very briefly, there's a lot of details in this, but this is what's going to allow us to look at old macro data and financial data and back out a prior sequence of what are these capital depreciation shocks. And then we'll also look at historical default rates. And it's that the co-movement of DT and the fee, the capital depreciation shock, that's going to allow us to recover this feedback, this obsolescence feedback loop. In cases where there's more defaults, how much bigger is the capital depreciation rate? Okay, there's a lot of parameters to calibrate. In a short talk, I'm not going to be able to do justice to all of these. These things are pretty standard. They're the same ones that we used mostly in the JPE paper. We don't have quite as much discounting here. Technology, so these are our production functions, our capital share. Alpha of 0.4 is very standard in the macro literature. The elasticity of the temporary shock, so that's a new one. That's about when this fee shock hits, how much of that ends up as a TFP shock, which is perfectly transitory, and how much of that ends up in this capital depreciation or obsolescence. And so we're matching estimates on the lower end of the 1-year GDP hit that we're likely to see to get out this decomposition relative to the movement in asset prices we've seen, like commercial real estate. So we've got depreciation of active capital. That's the normal depreciation rate of 6% per year. We've got idiosyncratic volatility. There's a debt tax advantage and a recovery rate. Those jointly are calibrated to match a leverage of about 0.5 and a default rate of 2%. And then we've got these default obsolescence feedback parameters. And those are new to our model, these two. And again, we're getting those from looking at the past history of defaults and of this fee series. So then we've got our epidemiology parameters. Some of these we're just taking from the epidemiologists. The new things that are interesting is the amount of capital idling needed to reduce transmission. We looked at how many people were working, were staying home in response to the lockdown policies. This basically gets us the Niemann and Dingle estimates of a third of people can do their job productively at home. A third of people can't but are required to work anyway because they're deemed essential workers. And about a third of people are idle. They need to be physically present and can't be and are sent home. And so this new of 0.5 gets us just about that breakdown that they've estimated recently. The recovery death rate is 1 in 18. That's consistent with the epidemiologists. The sensitivity of lockdown to past infections, don't know what that thing is. That's a policy choice. It may be different tomorrow than it is today. Our president seems to be a little whimsical about this. Governors are choosing different things. It's hard to know. So we're going to try a really strict one, which is just our 300 scenario, and a much more lax one. So one that is 6 times less responsive, and that's 50-50, and I'll show you these two. And then the monthly obsolescence of idled capital is 6.5%. And that's chosen to match the fact that we just saw a 10% drop in the value of commercial real estate. You really need to wipe out the value of some of that capital for a long time to see such a big price movement. Okay, So the effect of the COVID pandemic. How are we going to estimate this? So we're going to start at a steady state of G hat 2019. Basically, start not knowing that pandemics could still arise in a modern economy. And we're going to estimate that using this series of fees that we've backed out from the aggregate data from 1950 to 2019. Then we're going to add one new data point to that data set, and we're going to run through these COVID policy scenarios. So basically, that whole epidemiology model gives rise to a fee shock, okay? And that fee, the fee tilde shock, and that fee shock is sort of a sufficient statistic for what goes on in the disease throughout that year. Okay, so we could have just made these things up, but we think it's useful to see what's their mapping to what's going on with the dynamics of COVID and how policy can affect them. Okay, and if we don't model the epidemiology, we can't have any role for things like lockdowns in affecting our model. So that Zeta 300, that's our tough lockdown scenario, gives us a fee of 2020 of about 0.9, so a 10% loss. And that also delivers, consequently, a change in GDP of 2020 of a 10% decline. Okay, so 10% drop of GDP is scenario 1. Scenario 2 is a Zeta of 50, so that's much less lockdown, a laxer policy. It results in only 5% of capital being obsolete and gets us a 6% change in 2020, 6% drop in 2020 GDP. So for each scenario, we're going to feed that new shock in, we estimate the new beliefs, we simulate future paths, both with and without future pandemics, and then I'll show you time series for capital, output, labor. I'll tell you about what's going to happen to asset prices in this model in the long run. And what you're going to see is not just one path of future draws, but an average over thousands of simulations or I think we did hundreds up until today, of simulations of future paths of aggregates. Okay. So let's start with infections, shutdowns, and beliefs. Scenario 1, this is the aggressive policy. So let's start with the blue line. At first, everybody's susceptible. So 320 million US residents, none of them are, well, I guess we started with one person who's got the disease right at the start, and that stays pretty low. This disease does not spread that quickly, for a few months. And even up until today, the estimates of people who've been exposed to COVID with the antibody tests are something like, 2% of the population. So not a lot so far, and we're about here. Okay, so we're starting to see more the infection rate. So these are just active infections. This isn't the cumulative of everybody's who've been infected. These are the active infections. And here's everybody who has gotten it and is either recovered or dead. And that includes all of these asymptomatic people that we never caught, that we never knew had it. So we're seeing this is the aggressive policy, and it's got a slower decline in susceptible, or a slower rate of infection than the lax policy. And that's what you see here in scenario 2. So if we don't clamp down as much, we're going to get a huge number of infections just about now, and fewer susceptible people and more recovered or dead people. So here's what the policy does. This policy, it's got these waves, and we've been hearing about second waves of infection, and that comes out very naturally from these epidemiology models, in part because, remember, the policy depends on what the infections were 30 to 45 days or 15 to 45 days ago. And so there's this lag. And so what happens is the infections kick up, and then the policy clamps down, then the infections go back down, that's here, and then the policy releases and says, okay, everybody can go back, but then the infections pick up, and then the policy clamps back down, okay? So there's our two waves. This is the R, the reproductive rate, and here's what's happening to capital idling. So we idle almost half of our capital right about now. We're starting to open up, and then we're going to do it again. We won't idle quite as much, but almost as much in the second time. And here's what this looks like in terms of beliefs. So here's that fee that results. So fee is like integrating all of this idled capital. Well, I guess no, it shouldn't be that area. All of this is our idled capital. And here's more idled capital. And we're depreciating it, the stuff that's idled, at 6.5% per month. And similarly here, this is only supposed to have one dip. That's the wrong series. We're integrating over one dip here, and that gets us about half as much loss of capital. Okay, and here's how these things affect. Here's the blue line is that 2019, the pre-pandemic beliefs, and the red line is the post-pandemic beliefs. Okay, gotta keep an eye on my time. All right, 15 minutes, excellent. Okay, so average future output. What's happening to the economy from all of this? So here I'm showing you, we've got our two scenarios. This is our our tough lockdown, and here's our lax lockdown. And here's what's happening to GDP. So one thing I should say is, as you interpret this, keep in mind, there is no value to human life in this model. Okay, we are just talking about what happens to the economy. So the fact that lax in all of these scenarios looks way better is because we don't count any cost of people dying. We're just asking the very limited question, what's happening to prices and quantities, okay? And obviously, if we lock down less, we're gonna have more production. Okay, so scenario one, we get a deeper dip. We're losing about 12% of GDP, negative 0.12. Okay, here we've got less. This is negative 6.5%. Okay, but notice that whether we have learning or no learning doesn't really matter for the size of the impact. In the short run, it doesn't matter. Use rational expectations for your 1 year estimate of the cost. You're not going to lose very much. But as we go forward, these two differ. So let's talk about what no learning means here. No learning means rational expectations. The definition of rational expectations is that the perceived data generating process and the true data generating process are always the same, which means you can't learn about the data generating process under rational expectations. You are assumed to know it. That's how we pin down beliefs in rational expectations. This is a slight deviation from rational expectations. It's not irrational, but we're assuming that agents don't know the true data generating process and they're estimating it from the past sequence of data. So these no learning guys always knew that pandemics were possible. They see one and they don't think that anything is worse going forward. They always knew that these could happen and this didn't change their mind. The learning guys are saying, wow, the world's a lot riskier than I thought. And because it's riskier than they thought, they're going to return to a lower steady state level of output. It's as if we're changing the data generating process. We didn't, but we changed their perception of it. And their choices, their investments, and their labor decisions and so forth depend on their perceived data generating process. It changed, so the steady state of the economy changed. So essentially here, there's more risk. And because that data, once observed, doesn't leave their data set, it stays in their internal data set and affects their beliefs. Those beliefs are martingales. That means that's like an increment to a random walk. We just move that belief random walk down. It stays low forever. Okay, so we have a similar persistent effect from beliefs here in the lax environment, but it's less, right? We saw something less extreme. It affected our beliefs by less, and so we're going to have less permanent effect. So here's a very visual description of what belief scarring is doing to this economy. But really, there are three reasons that are built into this model about why the costs last beyond 2020. Okay, the 2020 loss is a 6 or 12% loss, depending on which scenario we're looking at. And the first is that, remember, we're making some capital obsolete, and that just takes some time to replenish, right? And that's something that, isn't particularly novel here. We're kind of hardwiring that in, but is kind of missing from the current discussion about what the loss of the COVID epidemic will be, is that there are things that we used to really like and that we're not going to do a lot so much. I don't think the cruise industry, for example, is going to thrive for many, many years to come. The second reason that there are costs that last beyond 2020 is that pandemics will continue to occur with positive probability, and we didn't really build that into our forecasts. That's not caused by COVID, right? They were going to happen, again anyway, but we might want to build that into our thinking, that these things seem to happen about once every 70 years. And then the third is the belief scarring piece. The fear of new pandemics reduces investment. So I'm going to try to break out these three pieces and quantify them and think about, what's the net present value of these losses. Okay, so let's start with a scenario where there are no more pandemics. And so we're just hardwiring, we're drawing from this distribution of possible fee shocks in the future to come up with many sequences of possible future realizations and then averaging over them. But none of those include another pandemic. Okay, we're just going to assume that for now, and then we'll think about the alternative. So in that world, you've got losses due to, this includes the TFP shock. That's basically what this 1 year bit, that's down here. It includes the depreciation of capital, and it takes a long time to rebuild. But all of that stuff is accumulating. And notice that, here by the time this is mostly resolved, we're out here in 2060. We're talking about 4 decades of rebuilding. after we're getting sort of discombobulated as an economy and rethinking the way that we're organizing work and leisure. And then the second piece is belief scarring. So that starts out being a very small effect, but it grows over time. So it both becomes bigger and becomes a larger fraction of the whole. And this is scenario one, the stringent lockdown policy, and scenario two, the more lax lockdown policy. In both cases, what belief scarring is doing is taking the estimate of the 2020 GDP drop and multiplying it by about 1.5. Okay, so just the belief scarring results in a cost that's already 2.5 times larger than the 2020 GDP drop. And then if you include the NPV of the obsolete capital, that's about 8 times larger than that initial estimate. So what we're doing is we're sort of integrating, this area. We're discounting, so we're downweighting stuff that's out here relative to stuff that's in there, and that's what this number is. And we're discounting using the correct stochastic discount factor, so the ratio of marginal utilities in each one of these scenarios, depending on what the shock is. Okay, so our point is not what will this be. We're just kind of taking some estimates and calibrating parameters to get that right, okay? So take whatever you think the 2020 GDP drop will be. We don't have a lot of insight on that. And belief scarring is times 1.5, and obsolete capital is times 8. So whatever you thought that direct effect is, blow it up 9.5 times, and you've got something close to what the actual long-term cost of this shock will be. That's really our message is, I don't know what that is. I'm taking some guess, but we ought to be multiplying it by factors of about this magnitude. Okay, so what if they're future pandemics? Well, then we've got another piece of cost that's just as big as the belief scarring part, which is, now this pandemic didn't cause this, but if you want to think about a question, for example, like what are the benefits of public health investment, then you really want to take into account the probability that pandemics can happen again. So if we're thinking about sort of what's the cost of pandemics, this one included, but also future ones included, and how much might we want to spend, well, the future 1 in 70-year pandemics will subtract another net present value, that's that integral of this area now, of another 16% here. That's 16% in NPV, and this is another 10%. So, depending on what you thought the right scenario was, investing 10% of GDP in public health measures that will prevent this from ever happening again looks like a reasonable investment, okay? But in both cases, again, I don't know what the initial impact is. You can pick your favorite forecast, but this is about 1.5 times the 1-year cost of COVID. Okay, so what's happening to investment? A lot of this, I said, was coming through the firm's cost of capital, and that's showing up in investment. And the big difference is, if you don't learn anything in a normal rational expectations world, if we take away a bunch of your capital and say, okay, that stuff's obsolete, nobody wants to use that anymore, that's kind of like, bombing part of the country, right? We're blowing up its capital. What do you do if you blow up some of your capital? You invest like crazy, right? So if you didn't have the belief changes, these guys, once they lose a bunch of capital due to obsolescence, are going to start investing like mad. The people who learn don't do that. Their investment recovers, but they don't do an investment surge. That loss is pretty much permanent, okay? And then they return to a lower level of investment going forward. Why? Because these people recognize that the world is a riskier place than they thought it was before. And that risk says, well, yeah, I'd like to replace some of the capital, but I also know that another pandemic will happen. If I'm a restaurant owner and I just got wiped out and I think about reopening that restaurant once everybody's vaccinated, I'm going to think twice about it because I know that this could happen again. And gosh, that was awfully painful. That's this new lower steady state. Okay, so without belief revisions, investment surges. And similarly, this is what happens to labor. Without belief changes, so the rational expectations world, we get a drop in labor, right? Because we send everybody packing and send them home. It takes a while to rebound. That's because we've got to build up the capital stock to our new well-adapted capital, but it eventually goes back to just about where we started, rebounds to the old steady state. Here, we get the same drop, but we rebound to a new worse steady state. Why? Because we think the world is riskier, therefore we invest less, therefore we have less capital. Because we have capital, we hire less labor. Okay, and that's true in both scenarios, regardless of how bad you think the COVID will be for the economy this year. beliefs are going to amplify it. And that works its way through investment, and it works its way through labor markets as well. It does not do very much to defaults. Okay, so realized defaults just don't change much. They don't change much depending on learning and no learning. They don't change much a lot going forward. They kind of, they're starting at about 2%. They're going back to 2% very quickly. So this model isn't seeing long run changes in default. And in part, there is more risk going forward. But in part, that's because one of the responses firms have to that higher risk is to borrow less. Okay, so they're going to be less leveraged. And we'll see that in just a second. We see a surge in riskless rate as investors want to invest more, but in the model with belief changes, the riskless rate settles down at a long run rate that's lower than where we started. Okay? And that's just that this looks like a riskier world. In a riskier world, safe assets are more valuable, and it's that more valuable safe assets that depresses the yield and results in a lower riskless rate. Okay, so what does all this mean? We've got a few minutes left. Let me tell you about finance. Okay, so one place you might expect all of this to show up is in credit spreads. So let me first say what I'm showing you are changes relative to what the steady state credit spread or equity premium or market value, all these values were in 2019, given the old beliefs, and what the steady state values will be once we settle down through all this transition dynamics, given the new 2020 beliefs that we have with pandemics, okay? So the credit spread is only 0.9% higher, 90 basis points. That's something, but it's not huge. And you might have thought that more risk would show up as a much larger long-run credit spread. It's not. Why is it not? Because debt is going down. Firms are deleveraging in the face of more risk, and that's making those firms safer and bringing back down their cost of capital. So there are these equilibrium responses that are mitigating credit spreads. The equity premium's a bit higher in scenario 1 than scenario 2. The market value of assets, you might think that a higher equity premium would bring down the price, the market value of assets, but remember there's less debt being issued and there's more equity being issued. Those two largely cancel out. We're getting very little change in market cap. This is that long run change in the riskless rate that I showed you from the last. Now, another place you might think to look at for assessing how much tail risk there is at the skew. The skew index is an index devised by the Chicago Board of Options, the same people who produce the VIX. And we haven't seen a lot of change in the skew index. It spiked a bit right at the start, but then it's been kind of mild. And that's really due to some quirks about how they structure the skew index. They do the third moment divided by the implied volatility, divided by the VIX. So at exactly the point where tail risk went up, the VIX also went up. And by nature, it's hardwired in that when the VIX is higher, the skew is lower. So these are not very big numbers. Keep in mind that the skew today was about 125. So a change of 8 or of 1.1, that's well within the normal movements of the skew. But if you extract the VIX out of it and you don't normalize by that volatility and you get out what the third moment is, you'll get negative 1.21 change or negative 0.21. Those are big. So just for reference, the third moment of GDP is negative 0.3, right? That's what captures the fact that GDP declines are more likely than GDP increases. So these are big numbers. We're seeing a big increase. If you measure the third moment, the implied third moment from options, so we're taking the skew and we're taking out the volatility adjustment they do, and we're getting the implied third moment, those look pretty big. I just want one moment on what if we'd seen this before, right? There was a Spanish flu. It's not like we didn't know there was ever a pandemic. If we've got more data, each new observation does matter less. But you might want to ask at the same time, maybe the stuff that happened 100 years ago, we don't see as relevant for today. I don't know about you, but before this all happened, I hadn't really heard of the Spanish flu. I was completely not cognizant of it. So we're going to do two things. We're going to, we don't really have data on FET. Our data starts in 1950, so we can't really go back further with real data. So we're going to make up some data. We make up data, and we're going to use 1950 to 2020 as a proxy for 1880 to 1949. And we're going to give those weights, those old observations, either a weight of 1 or a weight of 0.99 for every year in history they were. So we're going to discount things by 1% per year. Okay? If there's no discounting of old data, if we think the Spanish flu is just as relevant as if it happened last year, then we're going to cut the long run effect that we predict in half. But if we have 1% discounting of old data, that means the Spanish flu is almost completely forgotten by 2020. And in addition, with discounting, we get a little bit bigger reaction to more recent data. The net effect of those two is the same as our baseline model. So punchline, more data with modest discounting yields about similar results to what we're showing you. Okay, we're out of time. Let me wrap up. The effects of COVID and pandemics, unfortunately, this is our bad news, will not leave us once the vaccine arrives. The largest welfare effects here are the long run ones. They're almost 10 times larger than the short run costs that are being estimated for this pandemic. This is rooted in the fact that no one knows what the true distribution of shocks is. I don't know it, you don't know it. And that's not that relevant for economic models for normal events, but it matters a lot for tail events because we don't have a lot of data out there. And new data, particularly new data on rare events, because this is the kind of events where we don't have much data, permanently reshapes our assessment of macro risks. And this changes our beliefs and substantially amplifies the cost of tail events because it makes what was a transitory event really a long-lived event. That's belief scarring. And, we offered you also a set of tools for embedding and disciplining belief scarring in quantitative macrofinance models. So if you don't like the way that we built our shocks or devised our amplification, I'd encourage you to build your own economic model that you like, but put in belief scarring because this is going to change the way we think, and it makes a big difference for what you think the welfare effects are in the long run. And that's it.
Great, thank you so much, Laura. That's a super interesting presentation. We are going to move into the Q&A session now, which is 25 minutes. Just as a reminder, if you do have a question, please use the raise hand feature. We already have tons of interesting questions here, so we're actually going to start out separating them a little bit. So we have some questions on learning, on some pandemic management, and some on capital use. And so we'll kind of try to take them and start in that order. So first question is from Snahil Banerjee at the UCSD.
Hi, Laura. That was a great presentation. Thanks a lot. It was very, very interesting. I want to better understand the comparison that you're making between the rational expectations and the learning investors, right? So just sort of broadly speaking, it seems like the rational expectations kind of know ahead of time that the world is a risky place. And so I found it kind of strange that, when these graphs, when we see the type of impulse response type graphs that you had, we don't start the rational investors off being riskier and therefore investing less and being more worried about the world. And so I'm trying to figure out, the learning investors, the main investors in your model, or the actors in your model, they're learning over time that the world's riskier than it actually is. But the REE guys should have kind of figured that out already and have been less, less risk seeking or more risk averse to begin with. So, how do we trade those off, or how do we compare them?
Great. So if I can answer that, Snehal, you're absolutely right. I don't know, maybe we weren't being, maybe the graphs were a little bit confusing, but what you're talking about is exactly what's happening. So if I can just share my screen, I'm just going to go back to the slide that Laura used. What we are plotting here is the change relative to the initial point. So as you rightly pointed out, the REE in levels is at a lower point than the low learning guys. Than the learning guy, than the economy in which there's learning. So after they see this event, both of them converge to the same level. But in the learning economy, that translates into a drop relative to the initial condition, whereas in the REE world, it's exactly what we started out with. So I think. And so,
sorry, and so like for the asset pricing implications, do I think of risk premia and the risk-free rate in the RE world to start off with as being different than the ones in the learning?
Yes.
Okay.
So I think, so the table that Laura showed, exactly. So, we were showing learning and just the learning this thing, but if you did the same graph as this for the asset pricing world, yes, we would have had higher risk premia, higher tail risk, a lower risk-free rate, all of those things. We should have had that to begin with in the RE. That's exactly right.
Perfect. Thanks a lot.
Great.
Okay. The next question is from Hengji Ai from Minnesota.
So Henry, yes, you're absolutely right. I think we are learning about the distribution in this non-parametric way. And if you had an infinite, you had a couple of questions, so if you apologize, I just want to make sure I'm getting all of them.
Oh yeah, so it's very
ahead,
interesting. Yeah, a very interesting paper. So I was gonna ask, how much quantitatively does this very flexible learning gets you? I guess my question is, the distribution that you're trying to learn is very complicated because it's described by lots of parameters, right? Suppose I start with the simple, by the way, I think this is a realistic way of modeling, but suppose I start with a very simple distribution, and that's described by a couple of parameters. With 50 years of learning, I pretty much know what these parameters are. How important it is that you have this kernel density estimator?
Okay, so 2 comments. You're right. I mean, so I think in principle, what's crucial is not the kernel kind of fully non-parametric aspect of it. What you want is a distribution that kind of meaningfully distinguishes between the tail and quote unquote the rest of the distribution. So in a world where, so suppose you, I mean, and in our previous paper, we spent a lot of time kind of experimenting with different specifications for that, and we went with this, which seemed to be the most transparent. But just one comment on that. Imagine, so suppose you had, let's say, 70 years of data. And let's say in our history, you've seen one bad realization there. That was the 2008-2009 financial crisis. So if you had a kind of a parametric form where there was a parameter which controlled the size and the shape of the tail, you're not going to learn a whole lot about that parameter from this data series. You're going to learn a lot about the rest of the distribution, but you're not going to learn a lot about what that one parameter of that crucial parameter. And so when you see one more observation, your estimate of that parameter does change quite a bit, and that would produce similar results as well. If on the other hand you had a parametric form where, you know, as you point out, 50 or 70 years of data was enough to learn almost all the parameters like pretty well, then our mechanism would be inoperative. But I think the point we want to make is that is putting a structure on beliefs, in particular linking the tail to the rest of the distribution, perhaps too tightly than what would be a realistic way of doing it. So I hope that kind of clarifies.
Yeah, I agree. That makes sense. Thank you.
Okay, great. Thank you. So for the next question, we're going to go to Ken Ahern at the USC.
Hi. My question was trying to understand how to interpret your results. It seems like your model is designed to provide the cost for shutting down. And if you didn't have any shutdowns in your model, it seemed like there'd be no cost. But of course, in reality, if we don't shut down, there's going to be some sort of cost. So I'm trying to understand what's the benchmark, what's the opportunity cost of shutting down. It might be that if we didn't shut down, there would be even worse GDP outcomes. Shutting down would have a positive effect. So can you help give some comment on how to think about it?
Great. That's a great point, Ken. So first, you're absolutely right. We are kind of abstracting from, you know, any direct cost of the sickness in terms of lost GDP. Our motivation partly comes from, there is some work, so this is something which there's a lot of uncertainty about what would be the GDP effect if you just let the disease run through. There is some work looking at the cross-section, you know, of various regions within countries, which seems to suggest that the direct effect of the disease itself is much smaller than the effects of a lockdown. And that's kind of what very loosely motivates that. But, you know, but I definitely want to acknowledge that these are things we don't have a lot of certainty around. And it's probably something we should think about as a robustness exercise here. I mean, it's conceptually easy enough to incorporate that, okay, you know, a lax policy, as Laura outlined, also has some kind of second round GDP effects. Conceptually, we could do that. Our instinct, or my instinct, is to say that that's smaller than the other effects we are capturing. But I think we should definitely dig into that a bit more.
I'm going to weigh in on this one and just remind that the main point is that the effects are much bigger than we thought. And if we also add costs of not locking down, then the effects are only going to be even bigger. So they're working in the same direction.
Okay. Great, thank you. Let's go to Neil Stoughton, who I think is at Arizona currently. Neil.
Hi. Thanks for recognizing me. I didn't realize I was going to be asked to do this verbally, and I think I already got some good responses from Venky. But just stating that in some sense, I think that this view of the aggregate may be missing some of the disaggregated aspects of capital, namely, it's as an example, these seminars are extremely useful and enable me to participate in something that I wouldn't otherwise have been able to do a couple of months ago. And so it's increasing, in some sense, I think, my human capital, and it's also probably increasing Zoom's intangible capital or their various capital there. So aren't we going to see importances here in the cross-section in terms, and what are the implications for expected returns?
Absolutely, Neil. I think, the cross-section is a very interesting, and probably a first order kind of thing to look at. I'll make two comments on how we have kind of loosely speaking thought about that. So one way to interpret the two scenarios that Laura presented is that we could also have said that the milder scenario corresponds not so much to a milder lockdown, but a milder kind of capital erosion. So that's one way to kind of think about that. In the way we did it right now, we presented it as a milder lockdown for an epidemiological policy, but something similar would happen if you did it on the depreciation side as well. That's one. And second, at this point, it's essentially a kind of a quantitative question. Do you think these alternative forms of capital will kind of step in the gap that's left by, the obsolescence of traditional capital? I think that's a big question, and one that, we still perhaps don't have a very firm answer to. My own take is that, so if you kind of look at the US economy, there's $3 trillion of non-commercial investment, non-residential investment every year. 600 billion, or like a fifth of that, or a quarter of that is something like structures. Another 40-50% is machines. There's a lot of stuff that's actually, the US economy actually makes a lot of investments in real physical capital. Now, to what extent that would be perfectly substituted away by these new forms of intangible capital, I think that's to be determined. And in some sense, the perspective we are taking is that, okay, that substitution, maybe it'll happen over a very long horizon, but certainly in terms of the horizons we are interested in, this is primarily going to discourage investment in traditional forms of capital. But I think that's your comments are certainly on point there.
All right. Thank you very much, Neil, for the question. Next question is coming from Sarah Quincy from Vanderbilt. Sarah?
Hi. I think this idea of belief scarring is really interesting. I'm just curious, either looking at countries that were affected pretty harshly by SARS or H1N1, or I'm an economic historian thinking about the 1918 flu and maybe using Raymond Goldsmith's data, which isn't flow of funds, but it's similar. If you could think about whether this sort of updating is present in other contexts other than the US right now, which is obviously really interesting, but the other sort of contexts.
So great point, Sarah. That's something we're actually working on. We're trying to figure out how to kind of use that information and that. So let me just highlight one dimension there, which is kind of very interesting. So you could imagine that this experience also acts as a source of learning for the health system and health policy in that country. That is what I would call like an optimistic scenario. That's a world in which we see a pandemic, the health system adapts in such a way that future pandemics actually become less of a big deal. Now, I think living in the US, I'm not going to hold my breath on that one. I think in some sense, I think that's kind of the angle. So there is some evidence that we've seen, especially with respect to SARS and MERS, that the countries that experience those outbreaks, actually learned a lot from them and adapted and modified their public health systems to respond to that. So to the extent that that happens, you wouldn't see the belief scarring. Sorry, I should be careful. To the extent that that happens and the public or agents in the economy actually perceive that as happening, you're not likely to see big belief scarring effects. So I think that's potentially a confounding factor we have to figure out how to deal with in looking at those experiences. But you're absolutely right. That's definitely a direction we want to go.
Great, thanks, Sarah. So next up, we have a question from Lucas Herenbrook from Simon Fraser University. Lucas.
Thank you very much. I'm also surprised I'm being called on. Thank you, though. Fantastic paper, but I think the previous question has already more or less covered the topic. So I'm just thinking that there's so much voluntary shutting down going on that, to me at least, it seems that what the government mandated lockdowns do is front load the lockdown, but not necessarily force it. So in the sense of your paper, it would matter for policy advice. So right now you have a lax scenario and a tough scenario, and the outcomes are very different. But I would wonder if the lax scenario is simply feasible for a government. So a government like Brazil's, for example, is trying not to shut anything down, so that would be the laxest policy possible. But I think the people are voting with their feet that they don't like that, and they'd really like to shut things down a little bit more, and that's how I see it.
Right.
Thank you.
So great point. I'll make two comments on that. One, I think I'm, as much as I love this model and this paper, I'd be very hesitant to make, kind of epidemiological predictions using this framework, or far less kind of epidemiological policy prescriptions on this. I think this model is perhaps, we're just taking something pretty standard and embedding into that. So that's a caveat I want to throw out there. I will say this though, I think, in the model, the way we have kind of built in the epidemiological bit is that, the extent of quote unquote lockdown responds to a history of infections. Now, we can call that a policy link, but it could also just capture what private agents are doing. You live in an area where you see a lot of infection, the government is doing nothing at all, but you start doing less and less of this stuff. So I think at this level of abstraction, this would capture that as well. The challenge then becomes, what is the right way to calibrate that function?
Thank you. That's awesome.
The
only thing is you can say that you don't mean to be for your paper to be interpreted as active policy advice, but right now every preprint is interpreted as active policy advice.
Yeah, we're just hoping there was such a sorry, go ahead. Yeah.
I'll add that if you look at Moll, Kaplan, and Violante's paper, they look at the optimal choice of people whether to stay home, and they find that people's optimal choices in the U.S. actually look kind of like U.S. policy. So yeah, there are a few protesters outside Michigan that obviously disagree with their governor's policy, but most of us, if the government told us to stay home, I think you're right. They got us to do it a little bit earlier, and that's not of a whole lot of consequence for the economic outcomes. A little bit, but mostly people would choose to do approximately what the government policy is doing and how we've described it.
Right. So I don't know if you've seen this survey, but apparently support for the lockdowns is higher than the percentage of Americans who say they like apple pie.
All right, very good. Thank you, Lucas. We are going to go to the next question here from our own Mariam Farboudi from MIT.
Hello. So I have a kind of a quick question. So in all the papers that I've seen in economics on effect of lockdown and like a pandemic, there is never a return of the pandemic. So the double peak never arises, neither when individuals optimally respond or due to policy response. So I was wondering, what is the intuition in your paper that you get the double peak?
Do you want me to take this one?
Yeah, so I think there's two separate things. I think, so again, I don't want to speak for the 15,000 COVID papers that are out there. All I want to say is the ones I have seen, you know, if you wrote down the standard kind of SIR, what I'm going to call the standard SEIR or SIR model, R is an absorbing state. You know, in many of the things you kind of go back, once you're in the recovered pool, I mean, death is obviously an absorbing state. I mean, unless you're a Hindu, I guess, but, you know, death is but R is also an absorbing state, and that's what prevents the kind of the resurgence. So in those models, if you design the optimal policy, the planner really doesn't want to create a dance. He just wants to kind of like smooth it out, and he never creates a dance. What we have in our model, the one thing we have to kind of highlight, what we have in our model is a reduced form, quote unquote, policy rule. Now, it's not, you know, depending on how you design that policy rule, you can easily get the dance to come back. Right? So imagine, let me give you a very trivial example. Imagine that, you know, your policy rule is every time infection crosses a threshold, you shut it down for 2 days. Okay, you're gonna go, you shut it down for 2 days, and then you're gonna go back again, and then you're gonna see the thing come back. So you can, so in some sense, the structure of the policy rule could get you, you know, something like that. Though I know one thing I want to say, I don't want to kind of emphasize that, you know, that is a feature and that's really the right description of the world. You know, we put in something we thought was reasonable in terms of lockdown, the relationship between lockdown and realized histories. But yeah, I don't want to kind of hold out that that's the optimal response, or that's that's the outcome of some maximization problem. Does that make sense?
Okay. I think it makes sense for the optimal policy. I think from what I can say, even equilibrium response absent all optimal policy never leads to a double peak either.
In ICANN et al, it does. In their second paper, it does. In their paper, in their extended versions, it does.
Yeah, in the extended version, it does. Yeah, but yeah, so I wanted to know why. What is the intuition in your paper which makes it does in the do have a double peak in equilibrium?
So that's yeah, we haven't played around with it enough, I think, but I think my hunch is there is a policy rule, there is a policy specification which would get rid of it, and there are policy specifications which have that. And I think we probably need to understand that. Sorry, Laura, go ahead.
I toyed more with this version of the SEIR model. The lag does it, the fact that policy responds exclusively to what happened 15 to 5 days ago, right? So it was high, policy brings it down, now it's low, policy lets go, brings it back up. That's not, you're saying it never happens because you look at optimal policy. There's nothing optimal about what we do. We're just trying to describe what these clowns are choosing to do for whatever reason, right? That's it. So that's why we get it, and you're thinking this never happens because our guys are messing up, but we're just trying to describe what we hear politicians saying.
Okay, thank you.
Mm-hmm. All right, everybody, thank you. We have one last question, which I'm very happy is going to be a fellow Norwegian. Hi, Björn, who's going to, from Björn Rocker from University of Wisconsin at Madison. Go ahead, Björn.
Oh, hey, Lars. Nice to see you. I didn't realize that I would be on live on camera either, but in this case, let me just say, when it comes to this idea of building the permanent shocks into the probability distribution, it's sort of different. I made a comment. There's just two observations. I think it's inconsistent with what we see in some derivative markets where shocks are pretty quickly mean reverting. You look at credit spreads. You look at the VIX. VIX is already back to sort of relatively normal levels. But there's another observation. If you look at probability tails estimated in S&P 500 options before and after the 87 crash, you'll find that the risk neutral distribution has a much heavier left tail following the crash. So there's some learning going on there. So agents clearly didn't realize prior to that that this sort of large event could happen. And then, so that's consistent with your story, I think.
Absolutely. I think, you know, you're absolutely right. I think if you really wanted to capture all the fluctuations in asset markets, both in levels and in these higher moments, we need more shocks, and perhaps more shocks with a more transitory kind of structure. So in some sense, what we are trying to do is to isolate this low frequency component from all of this stuff. And that's what we are really focused on. I think, so for example, our model would predict, after you see an event like this, your left tail, probability goes up. Now, whether that is, in the data, the skew is much more volatile than that. There are a lot more fluctuations in this. So what we would like to do is to kind of strip out a low frequency change in the skew. And that's what we would like to map to what our theory finds. And so I think the idea that there are more transitory mean reversion in the real world than in our model is, I think, is a point absolutely well taken.
Okay, we're going to have to end it right there. Thanks to everybody for attending and for tons of great questions. And thanks to Laura and co-authors for a wonderful paper, great presentation. I want to remind everyone.
Organizers.
Yeah,
thank you so much, guys. It was a pleasure. Thanks, everyone. Yep.
Great. So next week, we're going to have Lars Hansen from Chicago talk. So please make sure you tune in. All right. Thank you.
Great. Thanks, guys.